I need to put one of you in charge of reminding me to record. Shoot. All right. Well, sorry about that. Now I'm recording. All right, back to my train of thought here. So as we talked about a minute ago, interest rate risk is greater for longer term bonds, right? It's greater for longer term bonds. So you can protect yourself from interest rate risk. And how do you protect yourself from interest rate risk? You buy short-term bonds, right? Buying short-term bonds is a way to protect yourself, right? As we're going to talk about tomorrow, though, this also helps us understand a lot about why long-term bonds tend to pay higher yields than short-term bonds. Why? Because long-term bonds are riskier than short-term bonds. Both there's more time for companies to default, but more importantly, there's more interest rate risk. So usually longer term bonds have higher yields, right? There's essentially a risk premium that you have to pay to get people to hold a long-term bond as opposed to a short-term bond, which doesn't have as much risk premium. So just for an example of this at work, if you go to Vanguard is, I think, the world's largest mutual fund provider. Vanguard has hundreds of different types of bond funds, right? But they offer bond funds that basically have low interest rate risk, medium interest rate risk, and high interest rate risk, right? Depending upon how much risk you're willing to accept. And so when they say a bond fund has low interest rate risk, what they mean is that it's only holding bonds that have maturities of between 1 and 3 years. What happens if there's medium interest rate risk? Well, then it's holding maturities of between 5 and 10. And high interest rate risk is between 15 and 30. So, this is the classic trade-off in finance of risk versus return, right? You can get higher returns on long-term bonds, but you're taking more risk. And specifically, this interest rate risk is a real thing, right? Because if market interest rates change and you have to sell the bond, you could take some really big capital losses, right? You could take some very big capital losses. And then finally, the last risk, and this is what I talked about in the first video that you watched this morning, is inflation risk, right? That in reality, investors don't care about your nominal yield. They really care about your real return. And so whatever your return is on holding an asset, you really need to think about adjusting that for the inflation rate. And as we talked about, unexpected inflation can eat away the real return from holding an asset, right? So I talked about a couple of examples this morning, right? If I remember right, I think I talked about the example of my mom and dad's mortgage, right? The bank thought they were getting a great deal, but in reality, the bank got toasted, right? They got toasted because, well, they might have thought that they were getting a 2 or 3% real return on my parents. They ended up getting a negative real return on my parents, right? So unexpected inflation can really eat away. So when you add these 4 risks together of default risk, liquidity risk, interest rate risk, inflation risk, right? Yeah, bonds are risky. Bonds are risky. They may not be as risky as stocks, but they're plenty risky, right? They're plenty risky. And in fact, some investors have data to suggest that over long periods of time, bonds can be just as risky as stocks. So if you are holding a portfolio, and I think this is a very common mistake by many people, they hold a portfolio and they say, well, I want to have some diversification. So I want some high risk, high return things like stocks. And then I want some low risk, lower return things like bonds. That is a very naive way of thinking about diversification, right? Because you can have bond funds that are just as risky, just as high return, high risk as stock funds, quite honestly, right? And so balancing your portfolio between stocks and bonds is not the only thing that you have to do to think about diversification, right? You have to do a lot of things. And in particular, you're going to need to diversify the kind of bonds you hold, as well as diversifying the kind of stocks you hold. All right. So anyway, I think that's really, along with understanding yield to maturity, having a really good grasp of these 4 risks of holding bonds. Those are in many ways I would consider to be the 2 big things to get out of chapter 4. All right. And so, both for your homework, but for that first exam that we take next week, I think those are concepts that you really have to have down cold, right? Because you're definitely going to see these concepts again on the exam, right? Understanding yield to maturity, understanding risk of holding bond, and understanding all the different ramifications of those concepts. That's a really important thing to understand. Okay, so anybody have any other questions? I think that really takes us through chapter 4, and really should take us through all the material that you need to be able to do homework number 1. So did anybody have any questions about chapter number 4? You get it? Okay, I'm going to take your silence as not boredom, but as saying yes. Well, we have a couple more minutes here, and so I would like to maybe get ahead a little bit and begin talking about chapter 5, right? So tomorrow I'm going to send you a to-do email here right after class. But the big things that you have to do tomorrow is we're going to actually cover 2 chapters, chapter 5 and chapter 6. Chapter 6 is a short chapter. Most of what we talk about tomorrow is going to be in chapter 5. But really the theme of tomorrow is, now we've kind of worked out the mechanics of interest rates, right? We understand how interest rates impact bond prices, and we understand yield to maturity, and like I said, we kind of understand the logistical part of this, the micro part of this. Tomorrow we want to kind of back up and talk about the macro part, right? Meaning, why is it that interest rates change, right? Why is it that sometimes markets demand higher interest rates? Why do markets demand lower interest rates? Why do interest rates go up? Why do interest rates go down? We also want to talk about, well, why do some bonds pay higher interest rates than other types of bonds, right? Why is it that treasury bills pay lower interest rates than corporate bonds in general, okay? So these kind of bigger picture questions are what we want to talk about tomorrow in chapter 5 and then in the shorter chapter 6. But I just, I'm not going to get too far into this today, because I do kind of want you to read it before I discuss it. But I guess maybe I have kind of some big picture things that I would like to talk about, right? Maybe like give you a little bit of history, right? Because I think from in many ways, one of the things that makes us Americans, one thing that makes us Americans is we don't really like to think about bad news and unpleasant things. But another thing that's more of an aside. Another thing that makes us Americans is I think we often don't really fully appreciate the history of things, and so it's hard for us to have a real grasp of how important some of these concepts are. Right? You heard me kind of go into this yesterday when I was, kind of bemoaning the idea that people don't really understand how important finance is when it comes to development, right? People don't understand the role that finance plays in their everyday life, right? They don't understand how finance makes their lives easier, right? And improves their lives dramatically. Because most of us have been lucky enough never to live in a world that we don't have access to ready finance. And so, if you think, back to history, right? Why are bonds and interest rates such important things, right, in the context of human history? Well, as I think I mentioned yesterday, interest rates go all the way back to the Mesopotamian Code of Hammurabi, right? that Code of Hammurabi basically says a legal interest rate is 25% a year, right? That's what you pay for money. Right? So you can borrow and you're going to pay 25% a year. That's a pretty high interest rate, but then again, it was back in Mesopotamia, right? There's a lot of risk associated with lending back then. Um, but one of the other things that we observe in human history as well, humans have both made laws that kind of govern interest rates. A lot of human laws have actually outlawed interest rates and outlawed the paying of renting money, of paying of finance. So in the Old Testament, there are usury laws, right? Usury, USARY. You might have heard of this word before. Usury laws are basically laws that ban the charging of interest. Many religions actually have these kind of laws. We're going to talk a little bit later about Islam. Islam has very clear usury laws, right? Very clear usury laws that ban the charging of interest. And so when we talk about Islamic finance is basically ways that people who are religious can essentially get around these usury laws, right? And there's a lot of actually really interesting history associated with this. For instance, we'll probably talk about this a little bit later, but one of the reasons why Jewish people are traditionally associated with finance is because Jews lived in the same areas that Muslims did. And while Muslims could not engage in finance, or at least could charge interest, Jews could, right? And so this was just simply a specialization, right? That this was an area that was open to many Jewish people that was not open to many Muslim people because of their faiths. So yes, usury laws have been common across history, and not just in Islam, but in many areas of Christianity and many different sects of Christianity that have banned the lending of money. I think, where do these usury laws come from? These usury laws really come from this idea, and you might hear it in social media, or you might hear from your friends or from people you talk with, that somehow earning money on interest is earning money for doing nothing, right? That somehow, if you can kind of have money and you earn interest on it, you're getting paid for doing nothing. But what I want to try to convince you of is, no, you are doing something with that money. And what you're doing is not doing something else, right? You're really being paid for the fact that you are not able to do other things with that money. Right? You're not able to spend it. You're not able to go on vacations with it. You're not able to buy big fancy cars with it, right? So when you get paid interest for saving, you're not getting paid for doing nothing. You're getting paid for not doing something, right? And that of course is valuable, right? It's valuable to society that some people are willing to get paid to not do something with money and let other people who might have something valuable to do with that money do it. Interest rates are absolutely, right, a fundamental price in our economy, right? So there's a reason why we spend so much time talking about interest rates, is because they really tell us a lot about how the economy in general is doing, right? They're a crucial component of how much your education costs, right? All of you are going to be directly impacted by interest rates because you're most likely going to have some college debt, right? That are directly tied to what the interest rate is. When you buy a new car, you buy a house, you're going to be impacted by the interest rate, right? So interest rates are going to impact you in the pocketbook, obviously. Interest rates are also a measure of how much people value the future. They tell us something about the future, right? They tell us how much people value the present versus the future, right? And then they tell us a lot about just overall macroeconomic performance. As we're going to explain tomorrow, one of the things we observe is that when the economy gets stronger, interest rates tend to go up. And when the economy gets weaker, interest rates tend to go down. And so, interest rates are closely followed measures of economic performance, both now and in the future. And so, you got to understand interest rates. If you're going to understand finance, if you're going to understand economics, you got to understand interest rates. And I'm probably preaching to the choir here, but yeah, you got to understand interest rates, right? You got to understand interest rates. Bond markets are also crucial to understanding, right? For whatever reason, bond markets are kind of like the sad, ugly sister of or ugly brother, I shouldn't be sexist, ugly brother of the stock market, right? I mean, everybody is kind of interested in what's going on in the stock market, and, you know, prices going up, and president, the politicians talk about the stock market every day. Nobody says anything about the bond market. As a practical matter, though, the bond market is at least as important as the stock market, right? The US bond market is about twice the size of the US stock market, right? So as a practical matter, the bond market is more important, right? And the bond market can tell you just as much about macroeconomic performance in the future as the stock market does, right? Bond prices, and of course, bond prices reflect interest rates, really represent the informed opinions of millions of people who are betting their money on their opinions, right? So these are just not the kind of opinions like someone calls you on the phone and says, who are you voting for? And you're like, I'll go with this person, right? No, when you put money on it, people think hard, right? And so, yeah, bond markets are informed opinions, or bond markets are based on opinions, but they are opinions in which people are actually betting their hard-earned money on, right? And so these are valuable, right? A little bit of history on bond markets. The first bond markets were actually in coffee shops and bars, right? In Italy, in the Netherlands were kind of the first places where these bond markets started up, where people would be sitting around drinking coffee and trading bonds, right? People sitting in the bar, and people would come up and trade bonds. The fact that bond markets today are everywhere really reflects technology, right? The fact that you can now be sitting at home trading bonds, you don't have to sit in some sort of public place and make face-to-face contact with people. When we talk about bonds, we really have to talk about two distinct markets for bonds. The primary market, and remember what primary market means, that's the market for new issues. Those new issues primarily come from investment banks, and they sell those bonds in a process that we call underwriting. Okay, if you remember, we talked about that yesterday. So if a company wants to raise money, they can issue a new bond through an investment bank, right? And we call that underwriting. That's the primary market. And then the secondary market is really for reselling these bonds. And who runs the secondary market? Well, it's dealers and brokers, right? It's dealers and brokers. So brokers are the people that match up buyers and sellers, and dealers are the people who buy and sell for themselves. But these markets are hugely powerful, right? Hugely powerful because, you know, once again, they really reflect the opinion of millions of people. I think one of the better quotes that I'm familiar of relating to the bond market comes from James Carville. Some of you might know James Carville today because he's on television a lot, on CNN, I believe. He's mainly on CNN. He's a political commentator. For President Clinton, he was kind of the chief political consultant. And James Carville once said, I used to think that if there was reincarnation, I wanted to come back as the president or the pope or a 400 hitter in baseball. But now I want to come back as the bond market. You can intimidate everybody. And that's true, right? I mean, a lot of policy, a lot of people kind of go around thinking, I don't want to spook the bond market. Maybe not this president, but past presidents, right, have been very worried about saying things and doing things to spook the bond market, right? To spook these people who are trading on bonds. How do these trades get actually conducted? Well, they're not conducted in coffee houses. They're not conducted in bars. They're essentially conducted through what are called electronic communication networks, right? Electronic communication networks. But they're just basically electronic systems, right? Many of these have no physical location. It's just the networks of dealers and brokers, right, who are connected to each other. A lot of this is kind of peer-to-peer, right? You guys are probably somewhat familiar with peer-to-peer lending, right? And other peer-to-peer applications. Well, a lot of this is just kind of at a bigger scale where brokers and dealers can meet up with each other and they can see prices of trades that are taking place. And from these prices, they can judge where the market is, right? And so, yeah, that's basically how these markets work. In last year, the value of the U.S. bond market was about $41 trillion. Okay, $41 trillion. So to put that in some perspective, GDP this year will probably be something around $20 trillion. So it's about 2 times the amount of GDP is the size of the bond market. And of those $40 trillion, once again, just to give you some idea of how big the different components are, the US bond market is about $15 trillion, right? So almost half of it, a little bit less, 40% of it is the US bond market. About 10 trillion is in corporate bonds. So about a quarter is in corporate bonds. About 4 trillion are in municipal bonds. These are the bonds by state and local governments. And then about 13 trillion are in securitized bonds. Okay, and if you remember what securitized bonds are from yesterday, those are bonds that are backed by other assets. So specifically, most of that $13 trillion is in mortgages, right? So those are what we're going to call mortgage-backed securities. They're bonds that are backed by the holdings of thousands of different mortgages. So that kind of gives you some rough idea, right, of how the bond market works out, right? That if I'm probably not getting the numbers that add up to 100 in my head, but about 40% is the government bond market. About 5% is state and local government bonds. About 25% is corporate bonds, and then the rest are securitized bonds, right? That's kind of how the breakdown works. Okay. One last thing about bond markets. The US bond market is unique, and it's primarily unique because of the size of our bond market, right? The US financial system differs a lot from other countries because we have a very big bond market, right? Our bond market is a huge portion of our total financial system. So in the US, very much our financial system is kind of 40% bonds, 40% banks, 20% stocks, right? I'll say that again. 40% bonds, 40% banks, 20% stocks. But if you go to other countries, for instance, let's just say China as an example, China is about 90% banks and about 10% stocks and about 0% bonds, all right? So bonds are not a big method of financing for many different countries, right? So there are countries that do have bigger bond markets, right? Some Northern European countries have some fairly developed bond markets, but particularly emerging market economies do not have very big bond markets. And so we'll talk about that, right? The US bond market makes up between 40 and 50% of the global bond market, right? So US bond market is a huge portion of the global bond market. And that's why, in a very real sense, our bond market, particularly our government bond market, is the center of the global bond market, right? If you live in another country, right? If you live in China and you want to put your money in bonds, you really, in many ways, you're kind of forced to put your money in the US bond market, right? I mean, there's other options, but your primary option is going to be putting money in the US bond market. And so, the US bond market is just really influential, not just in the US, but outside of it, because it's really the place where you can get access to a large, stable, vibrant, and relatively safe bond market. Okay, so that's just kind of some background stuff so that we kind of appreciate the importance of bonds. But like I said, I don't think I really want to get into what we'll call the meat and potatoes of chapter 5. I'll let you kind of read through this and then we'll talk about this tomorrow. All right. So as I said, I'm going to immediately send you an email. But tomorrow, the big things are to read through chapter 5, read through chapter 6, which is much shorter. I'm going to give you one additional article to read that will be what your daily response is over. And then also make sure you spend a little bit of time on homework number 4 so that if you have any questions, you can ask me about it in class tomorrow, okay? All right, well, any questions before I let you all go? Okay. Well, have a good evening. Enjoy things. And unless you hear something different from me, I will plan on seeing almost all of you back in class tomorrow morning at 9. Okay. Have a good evening.
Thank you.